Hi, this is Anthony Parent of Iris Medic, and we are live this morning, and we are going to be talking about the Canadian First Home Savings Account. And with me is John Richardson, and he just had some tweets up. He's been on top of this. This is a brand new thing out. There's not a lot of guidance on it, but John is concerned that many Americans who are in Canada are going to be confused by this. So, John, what is this all about, and what is happening, and is this a good thing?
Well, let me start off with the last question. Yeah, it's a good thing. Okay, generally, it may not be the best thing, but it's obviously a good thing. Problem is that this is a registered account, which we'll describe in a minute, but it's very much in the family of the TFSA, the RESP. These will mean things to people in Canada. Registered accounts that provide tax deferral in Canada, but are of course not recognized under the U.S. Internal Revenue Code as providing tax deferral and are not discussed in the Canada-U.S. tax treaty. Ergo, income earned inside the plans would be taxable to U.S. citizens in Canada filing returns. So hence the concern. And, like the TFSA, the general message is that Americans in Canada should avoid the TFSA largely for two reasons. First of all, over concerns that they're foreign trusts. And secondly, because the income inside them is taxable. And then, of course, if the income is taxable, that raises, as always, a PFIC concern, et cetera, et cetera. I wrote a fairly lengthy post where I actually did it along with a CPA to actually provide the returns and what it actually looks like, explaining a number of things. First of all, and this applies to the new Canadian First Home Savings Account that I'll get to in a second, but I just want to deliver the bottom line here. That one, like the TFSA, they don't have to be foreign trusts. I mean, you could structure them so that they're a foreign trust if you really want the paperwork, but who would do that in their right mind?
Yeah, yeah.
That depending on how you file U.S. taxes, if you're using the foreign earned income exclusion, that gives you a $12,000 standard deduction to shelter income earned inside a TFSA, or now the FHSA from U.S. taxation. So the bottom line is that there may be many U.S. citizens in Canada who will not find this to be a useful product, but I think that for the people who it's really aimed at, namely younger people who are trying to save for a first home, I think that this is likely to be helpful it is to any other Canadian resident. And I think that people should proceed on the basis, if you're an American in Canada, that it is workable and not that it is not workable. I mean, that's the basic message. Okay. Now, the basic features of the plan, and again, I'm going to be very general here because honestly, this has been out for less than 24 hours. I've got the gist of it, but there's all kinds of details that financial planners will no doubt, get into here. But what it is, okay, first of all, you have to be a tax resident of Canada. Secondly, you've got to be 18. This sounds like the TFSA so far. Thirdly, you can actually contribute 8,000 obviously Canadian dollars a year to this plan to a lifetime maximum of $40,000. Now, what's interesting about this though is that the contributions are tax deductible in Canada. Okay, for U.S. citizens,
Wow.
yeah, and they're cumulative, so you could actually wait 5 years and then contribute 40,000. However, U.S. citizens in Canada need to be careful because if they use a Canadian deduction and reduce their Canadian income too much, they might not have enough tax credits, et cetera, et cetera.
Ah, okay. So yeah, you probably want to avoid that
You
lump
want to
sum,
stage it out,
right?
okay?
Yeah.
But this is between you and your accountant sort of thing. So that's the first thing. So the contributions are tax deductible. Secondly, as is the case with any tax deferred plan, the growth inside the plan is actually tax deferred. So let's say you have a self-directed plan and you invest in, whatever, stocks, individual stocks. Avoid Canadian mutual funds for PFIC reasons, but you invest in Canadian stocks. The growth, okay, and the income will not be taxable in Canada, but it would be taxable in the United States. So you want to pay attention to that. And then finally, at the point that you want to buy the house, you can, distribute it. You can distribute it, and use the proceeds to buy that house, without any further inclusion of taxable income. So, it's not bad. I mean, it's a way for the Canadian government to help subsidize, I think, a down payment on a house for uh, a certain kind of person. It operates along with the TFSA and the RRSP. And there are provisions actually to transfer from the RRSP into this new thing, to get the money if you don't have the money for a contribution, or to go backwards. So it did occur to me that one of the unspoken uses of this could be lifetime renters who've never owned a home. You have to be a first time home buyer. Could actually create one of these plans and eventually roll it into an RRSP, sort of thing as well. So this has some interesting financial planning features. But the reason I want to do this podcast with you, Anthony, because I can just see, immediately all the U.S. tax preparers in Canada for saying, "Oh no, no, it's going to be like these other things. Stay away." And I don't think that's necessarily true at all. So that's my message for today.
Well, you surprised me. You honestly surprised me because we actually had something a bit of good news, and I think that's the thing. Because what you tend to hear is there are things that really hurt U.S. Americans living in Canada. We just talked about the underused property tax. We've been talking that a bit. Some bad news there. So this is actually something that don't believe the hype that it's bad. If you're an American, you actually can still use it. Do a little planning, do it the right way, but it's a way to get that down payment out
Yeah.
to.
I mean, it's not fantastic. It's not earth shattering, but it is helpful. And I think that if I've learned anything about this stuff over the years, which is obviously not as much as I should have,
Yeah.
but what I have learned is that simplicity is virtue. And that the best time to get started with these things is now. Sort of thing. And particularly for younger people with lower incomes, right?
Well, and that's why, and by the way, I just want to thank you for this because you look, older people tend to have the resources to hire the best tax professionals around. But I'm thinking, a lot of our a lot of our content really can't help a lot of younger people, but this is one that can. This is something that's okay. You don't have the money to hire a lawyer to do this. You don't need it. You probably don't need it. You just talk to someone who's you're a decent preparer to say, no, it's okay. It works out all right. So I love that. I love being able to help out everybody,
Yeah.
not just.
Anthony, can I also just emphasize again? I think this is so important. Okay, but for the same reasons that I don't believe most TFSAs or foreign trusts under the U.S. rules, these, it's clear to me, can easily be structured so that they're not foreign trusts. So if anybody tells you that you presumptively have to file a 3520 or something, just go find somebody else. Okay?
Well,
That's really
thank you.
the case.
Yeah, so some technical things that John brought up. He brought up a PFIC, that's sort of passive foreign investment company. That's usually taxation that you want to avoid. That was put in the code in 1986 as a protectionist measure to help Wall Street and to punish um, foreign mutual funds, anything like that. And the other thing that John mentioned was Form 3520, and that is in Form 3520A, and those are forms that are required when you have what's called a foreign trust, and the penalties can be significant, and it gives the IRS sort of fodder. So it's something, if we could avoid that for our clients, we try to avoid that trust reporting. Typically, it's done correctly for us, but again, there's a lot of people around the world who might not be doing things correctly, exposing to risks. So that's why we want to avoid having a foreign trust if we can.
Yeah, and just to add to that, Anthony, it's quite possible that people don't know what a PFIC is or a vague idea. It's far too technical to explain.
Yeah.
Let me just say the following for listeners. A Canadian mutual fund is almost certainly going to be deemed to be a PFIC. Okay. So, if you're going to create one of these things as a U.S. citizen in Canada, do not use the money inside to buy a Canadian mutual fund. Okay. So that's just another safe harbor for you. And, and if you just make sure that you avoid the kind that is specifically designed, okay, to be a trust, it's actually called a trust one. Okay, in
Yeah.
other words, you can create one that's a foreign trust, but you're not going to do that. Why anybody would do that is beyond me anyway. Okay, but you're not going to do that. Number one. Number two, you are not going to put any Canadian mutual funds in it. And I think probably you're golden. Okay, if you do that.
All right. Well, thank you. Well, now I'm gonna ask Keith for his quick reaction. Keith has been listening in. Our good
Yeah,
friend Keith Redmond. Keith, so any reaction you have about this? It sounds like it can kind of be good news. So, what do you say?
that's good. It's refreshing to have some good news for Americans living outside the US in this particular situation in Canada, because
Yeah.
normally it's so restrictive for American immigrants to do anything. So happy to hear that this is a viable financial product in Canada that Americans can use.
Yeah. Also, please remember this, okay? As always, it depends on your circumstances and how you're filing.
Right.
This is very, very
Yeah.
good. Like, assuming the people who are going to use this are mainly younger people who, want to save for their first home with employment type income. It works best, okay, for sure, for those who are using the foreign earned income exclusion for filing, right? Because that frees up
Yes.
$12,000 US, like
Yes.
15,000 Canadian to shelter income thrown off from something like a TFSA or the FHSA, right? I mean, frankly, if you're, sort of a younger type of person, by that I mean 18 plus, sort of thinking about this stuff, I absolutely encourage you to get started with investing. But I also encourage you, even if you are a U.S. citizen, to explore the TFSA and the FHSA, both of these, okay? Because if you're using the foreign earned income exclusion anyway, and probably you can or are, all right, you're going to be able to exclude the income earned inside these things. Or not, I'm sorry, you're not going to be able to exclude it. What's going to happen is the standard deduction gives you effectively 12,000 US of income that's excluded from US taxation. But look, the bottom line is simply this, okay? If you're 18 plus, resident in Canada, afflicted with US citizenship, fear not, get out there, get involved with the TFSA and the FHSA. Just make sure that you don't get into the type that are foreign trusts, okay?
That's beautiful. Beautifully said. Thank you so much, John. Thank you for sharing your wisdom with us all. Hey, this is Anthony Parent for IRS Medic. For John Richardson, Keith Redmond. Thank you for watching. And I did link to John's article in the comments, so be sure to follow that. Follow up more on what he's saying there. Thanks again for watching, and we'll see you again soon.